So now that we're got everything kind of off the ground and stuff, like he was saying, my name's Derek Long. I just want to be very open and honest with everyone. I am a expert when it comes to understanding the tax code and the court cases behind self-directed IRAs. So really, you can ask me any questions, whether it applies to the company I work for, which I work for Quest, or any company you maybe already be affiliated with. I do speak in front of Congress, usually on a quarterly basis on these topics. I do sit on what they call a government relations committee, which is actually really unique for myself. So I just tell people I'm a nerd, I'm an open book. Ask me any questions as we go along, and I'll save a lot of these questions for the end. Now, I do have a little presentation. Did you want me just to dive right into it?
Yes.
Yeah, sure. So what I'm going to do is I'm going to go over what I call a basics level of self-directed IRAs. The reason why is sometimes they put too much thought into them. So this is just how we use IRAs, understand the bare bones, and then we'll get to how to use it for multifamily purposes. So as I kind of go through these things, remember, real quick disclaimer is I'm only here for your guys' educational purposes, right? Once again, I'm an open book, but I can't give you any legal advice or investment advice, or I can't endorse any products. So what we're going to learn today is, like I said, the IRA basics, why it's important to you, how to use it for multifamily investors, and then honestly, how to get started with your first deal. So we need to, first off, on the bare basics, understand that the IRS puts everybody in two categories, right? And they say, hey, you're either this type of entity or this type. Those being a taxable entity or a non-taxable entity. Most of us are familiar with the taxable entities, right? This is anything you establish, right? You work a job, a W-2, a 1099, you set up an LLC, a C Corp, an S Corp. If you create a trust, every one of these become a taxable entity because you set it up. But the IRS gives us non-taxable entities. Now, when I say this, usually the first thing that will come to mind might be a church, a charity, a nonprofit organization, sometimes a hospital in certain scenarios. But believe it or not, an IRA, a self-directed IRA, a solo 401k, or a QRP plan are all labeled as non-taxable entities via the IRS. So just remember that. I can do the same deal personally, but I have to pay taxes on my income. I can do the same deal in my IRA, and I don't have to pay taxes today, sometimes ever, if it's things like a Roth. We'll define that later on. So knowing that, what is a self-directed IRA? A lot of you out there after this will tell me, well, Derek, I need to set up one of those SIDRAs or an SDIRA or a self-directed IRA. You can look everywhere you want in the IRS tax code. Believe it or not, self-directed IRAs are made up. That's a marketing term that the industry utilizes. Self-directed IRAs do not exist. What it comes down to is what the custodian or the bank will let you invest in. If I have an IRA at something like a Fidelity, a Charles Schwab, Wells Fargo, Merrill Lynch, something like that, a Vanguard, they might call it a self-directed IRA, but I can only self-direct it into stocks, bonds, CDs, mutual funds. I can take your same account there and move it over to a company like Quest. Quest will let you do the same thing, but we're only going to let you self-direct it into things like real estate assets, single family homes, notes, multifamily syndications, etc. So which one's better or worse? Neither. Notice if I want to use my self-directed IRA to buy stocks like Apple stock, I have to go to Fidelity. And if I want to use that same self-directed IRA, right, to buy and invest in a syndication, I have to come to Quest. So we each serve a purpose. Try not to think that one of them is better than the other. They're just different. One lets you invest in A, the other lets you invest in B. Then this also means that there's a lot of benefits with it. Typically, the first one being a form of true diversification. Remember, a lot of times I'll ask someone, hey, do you have a 401k? Do you have an IRA? Yeah, you do. Great. What's it diversified across? And you tell me all sorts of things on the public market, right? The mutual funds, the annuities, and maybe some stocks. But the problem with that is that's all public assets. Now, I argue, let's take a portion of those funds and move it to what I call the private sector. All right. Private sector being actual tangible assets, things I can touch, feel, see, look at, things like investing into a multifamily deal, using my IRA to invest into those types of syndications. Notice that's real diversification. Now I have public assets and private assets. The biggest benefit for most of you out there, though, will be the tax savings. And I saw Jamie's question earlier, so we'll talk about that as well. But remember, when I do an investment personally, all my income is taxed today, whether it's a dividend, right? Whether it's when they refinance the property, whether it's when they sell the property 3-5 years down the road, any profit I make is taxed today. Now, because of that, you do get some deductions along the way to offset the tax. But I can use my IRA and avoid 100% of the taxes. If that's the case, though, I'm not going to be able to take deductions. Right? So understand it's a give and take. The one thing, though, I really appreciate, and it's something that I think a lot of maybe financial advisors or CPAs or tax attorneys won't touch on, is I call it investing in what you know best. When we're using a true self-directed IRA, it's because you're taking the time to educate yourself on a brand new asset or a brand new investment to invest in something that you understand. All you guys are on here to learn why and how to invest in multifamily for a very specific reason. Well, then why is it that we have those 401ks all put into the Fortune 500 stocks? It's because you probably didn't realize this was an option where I can take that same old 401k and invest into one of these multifamily deals. So just remember that, right? We can have some good diversification. We can avoid a lot of taxes on our earnings, right? And lastly, be able to invest in something that we truly understand. Now, typically, the 7 accounts you see here on the screen are the 7 accounts that are the most popular to be self-directed. Love my coffee. The first one being that traditional and Roth IRA. Notice a traditional IRA is a tax-deferred account. It's an account that grows tax deferred. I'm pushing the taxes to a later age, right? When I'm usually about 72 is when the IRS will say, hey, you owe us some taxes. The Roth is that big sexy account, that one that grows truly tax-free to where you have zero taxation once you're 59 and a half. You do have some employer plans like a SEP, a simple, a solo 401k, and even what we call specialty plans like an HSA or health savings account, or an education savings account for your kids, typically for college or maybe some private tuition or something along those lines. So these are the 7 accounts that are the most popular that are being self-directed across the board, all right? So once again, I want you to remember that every one of these accounts you just saw are tax-exempt entities. When any one of these IRAs do an investment, all the earnings avoid all of the taxes. So if these entities are going to avoid all the taxes, the IRS puts some big restrictions on there. What they call people restrictions, transaction restrictions, and investment restrictions. Now, believe it or not, the only one you guys really care about in this situation is the people restrictions. And the IRS says, hey, there's certain people that are disqualified from your IRA investing into. So I always say we want to put our IRA in its own bucket, your 401k in its own bucket, all right? That IRA is going to invest into something and it can't be certain people. The first one is yourself. I can't use my IRA to lend myself money and say, hey, well, that's an investment. No, it's not. That's a loan, right? I can't use my IRA to buy myself a house, go live in it, and say, hey, that's an investment. Nope, the IRS says that is not an investment, that's a homestead. All right, Derek, well, I got an idea. What I'm going to do is I'm going to set up an LLC. Nope, the IRS is not that dumb. They give us this ugly chart you see right here on my screen. I break it down real easy, but they always say your retirement account can't invest into yourself, your spouse, your parents, grandparents, your kids, your grandkids, or their companies. Anyone I just labeled on that list, you, spouse, parents, kids, and their companies, my retirement account cannot invest into one of those individuals. But that's okay because most of you guys are not out there trying to do that, right? Usually what you're trying to do is you say, hey, I found someone I want to invest in. I'm going to take my retirement account and I'm going to go ahead and invest into this syndication. So as long as you're not the owner of the syndication, the actual general partner, right? You're just one of those limited partners, that is not a problem. So if you do try to be sneaky and get around this rule, the IRS says, hey, you just did an investment with a disqualified individual. So we're going to call it a prohibited transaction, whether it's directly into them or indirectly into them. And what they're going to do is they're going to take away your entire retirement account. So think about that just for a minute. This is money you have saved up for 10, 15, 20 years. And during that 10, 15, 20-year time frame, you've been shoveling money away. And by you trying to be sneaky and invest and buy yourself a house to go live in it, the IRS could catch you and they take away it all. So it's a very scary thought. Now that I've scared the pants off you, remember, we can actually really invest into anything else as long as it's not yourself, parents, kids, right? We can use these IRAs, these 401ks, these retirement accounts to buy single family homes and foreclosures, right? You can use it to invest into LLCs and syndications and multifamily deals. You can use it just to be a lender, right? To lend money via a secured note or unsecured note or convertible note. All these are very common and there is so much more. So I like to break down exactly how we use the IRA. And it always comes down to two ways. One is what I call direct ownership of the IRA doing the investment, or ownership through an additional entity, AKA checkbook control. So you'll hear both these terms used a lot, but we're going to start with the direct ownership because it is the easier method of the two. So what this means is when you set up an IRA, your IRA will look just like this. Believe it or not, your IRA will be labeled its very own entity. It'll have its own name, its own address, its own tax ID number. So remember, you're going through the motions. You found the investment. You did the due diligence. You're like, yep, I want to do this deal. But when you fill out that subscription agreement, you don't put your name on there. You put your IRA's name. It's not your address. It's the IRA's address. It's not your social security number. It's the IRA's tax ID number. Knowing that, the IRA can now go ahead and take title to whatever the investment is. It literally will send money in exchange for that title, right? The IRA sends money to the title company. The IRA is the true owner. But if the IRA is the true owner, who gets all the profit? The IRA. You're still going through the motions. You're still in control. If you've ever set up an LLC, a C Corp, an S Corp, you've already been doing this. You're still finding the investment, doing the due diligence, filling out the paperwork. But on the paper, you put your entity's name. Well, in this case, the entity is just an IRA. This is why all the profit goes back to the IRA. This is why the profit is tax exempt today and sometimes truly tax-free, even in the future. So behind the scenes, what's going on? All right, I always say in this type of example, your custodian, in this case would be Quest, stays involved. If your custodian stays involved, they're the ones helping you out through all the paperwork, right? It's a very clean way to do the transaction. You know why? Because the IRS audits your custodian on average 5 times a year. 4 times by the banking division and once by the IRS. Think about that. Are you being audited 5 times a year? Probably not. So knowing this, the IRS is not looking at your books, they're looking at ours. So this is good for people. All right. It does take about 48 hours or less to fund an investment. So don't call someone and be like, all right, I need to set up an account today to fund a deal tomorrow. It will never happen. All right. Don't forget about your custodian's fees. Quest, if you want to go through this type of motion, we're going to charge you $125 to do this investment. Why? Because we're taking on the audit risk and we're holding your hand through the whole process, right? So as long as you're familiar with that and you're up to date with it, this is how it works for every single custodian out there. Remember, this is how the IRA takes title to the deal. So what we're going to do is look at just some pros and cons to this. I always say it's an easy way if we want to partner multiple IRAs together. The IRS really likes it. And this is a great tool if you are a beginner. All right, so if this is your first time ever doing a deal with an IRA, I think this is the best way to go about it because it is for a beginner. There are some cons for it, being a fee. Don't forget that your custodian, Quest in this case, we get to charge you a fee every new investment you do. And if your custodian's not talking about those fees and very open about them, run. Most custodians, I think, they try to hide them. And that's what's bad in today's industry, in today's day and age, is a lot of times people, they try to hide these type of fees. Right? You have to do some book paperwork, things like FMVs and direction of investments. Now, we're going to help you with that, right? But it's internal paperwork that the custodian will always need. Lastly, Quest sees everything you're doing. Why is that important? Some people don't like that. Some people want their name off of all the county records. They want to hide all their name. They want, 10 levels of asset protection, and they'll go through some extremes for this. That's okay. I actually have a solution to every one of these cons, and that's that checkbook control way. The problem is, I'm going to walk you through right now how to get the checkbook control. And remember, this is the easy way to go about things, the way you see it on the screen. The IRS likes this. It is a great way if you're a beginner. Even though I'm telling you this is the way to do it if you're a beginner, a lot of you are going to see the checkbook control way, see some advantages to it, and you forget about all the disadvantages. And even though you've probably never used an IRA before in your life, some of you might try to jump to that method, and it will make things more complicated on you in the future. So I'm just putting that kind of warning out there before I dive into this next way, being checkbook control. Be careful. Now, let's dive on into the best topic in the world in the self-directed industry, defining checkbook control. It's when my retirement account has a bank account of its own, not tied to the custodian. This is important to understand because the IRS does not recognize the term checkbook control. That is not a legal term. That's actually just like self-directed IRAs. That's just a marketing term. The reason that's important to understand is if you Google it, you'll get 50 different articles on 50 different points of view. Understand that anyone out there can write an article. All right, so we always want to look at it from what I call court cases, make sure there's a court case to back up whatever it is they're saying, and B, actually reading the physical tax code. So understand all a checkbook control means is when my retirement account has a bank account not tied to the custodian. All right, so what does it mean? What it is, I'm going to take 3 IRAs. Remember, each of these IRAs have their own name, their own address, their own signature, their own tax ID number, their own level of asset protection. Notice I made all 3 of them equal out to be 100 grand. You found this syndication, you want to invest $100,000, we got a problem. You said, man, Derek, I don't have $100,000 in one IRA. I got $25,000 in my Roth. My wife has $71,000 in her Roth, and my kids, I set them up a couple accounts and they have $4,000 in theirs. How can I use all 3 of these IRAs to invest into that syndication? All right, well, what we have to do is establish an entity in the middle. Call it a trust, call it an LLC, whatever you feel comfortable with, whatever the state you're in or the country you're in feels comfortable with doing. But these IRAs will actually create their very own entity. I call it an umbrella that holds all the cash. Now, the reason I made all these accounts equal out to be 100 grand is because guess what? That would be their percentage of ownership. Notice my Roth in this example holds 25% of the LLC. My spouse's Roth holds 71% of this LLC, and my kid's ESA holds 4%. But here's a problem. Each one of these IRAs aren't physical people. These IRAs will be labeled either as the member or the owner of the trust, but they can't be labeled as the manager. Why? Because they're not real people. Normally, when we as individuals set up an LLC, right, we call ourselves the managing member. Well, this is because you're the member, being the owner, and you're the one managing it. But in these cases, the IRAs are the member, Who is the manager? It can't be you. The reason it can't be you is because the IRS says, nope, now you invested into yourself. Remember, I talked about those prohibited transactions earlier. So believe it or not, you have to assign what we call a non-disqualified person, someone that's not you, not your spouse, parents, or kids, to be labeled as the manager. That's important to understand because a lot of times people miss this step. And missing this step, what ends up happening is they enter into a prohibited transaction. Remember, that's where the IRS can come in and take away your entire retirement account. From there, though, this entity you created can do as many investments as it wants. Notice, doesn't matter how many investments you do, there is no more fees. That's why people like this method is Quest no longer has to charge $125 for every investment because we have zero oversight on you. The LLC is going to go out and buy A, B, C, D, meaning I have no clue what that LLC or that trust does. That's why people love this. Now their custodian's not bugging them for documentation or forms. You no longer have to pay your fees. Like, this is an awesome tool. But remember the oversight. If Quest, who is being audited 5 times a year, is not going to give any oversight to this entity, where do you think the IRS looks next? They look at you. That's why they can be very dangerous, right? So knowing that, let's look at some pros. I say it's very hidden. It's super cheap on fees and easy for check writing ability. Some of the cons, though, is that non-disqualified person. Remember, it can't be you, spouse, parents, kids. It could be a brother. It could be a sister, an aunt and uncle, a niece, a nephew, another business partner, right? An attorney. Doesn't matter. Just it can't be you, spouse, parents, kids, right? You need to set up the entity, aka an attorney, usually. I can't set up the entity for you. Lastly, it's not the IRS's favorite method, making it a dangerous responsibility. So those are kind of the ways to kind of go about it. Some people I know, they debate, oh, well, you're allowed to be your own manager. Be very careful with that, guys, because if we actually read the IRS publication, it straight up says right here under IRS publication 4975, and I have it cited right down here if you guys want the actual cite to it, that it says the act by a disqualified person who's a fiduciary can't deal with the income or assets. So be very careful. I know some custodians will let you. The reason they let you do it is they're there just to charge you a fee, right? They know that they're not the ones going to be audited and get in trouble. And you can see this time and time again with multiple court cases. The most recent one that just came out in November, labeled McNulty versus Commissioner, was in November of 2021. The McNultys lost their entire retirement account because they held their own checkbooks. So be very careful with that, guys. Overall, I can talk about setting up the account and stuff, but I want to make sure you guys have my contact info, and I want to make sure we have room for Q&A. So here's my email right here. I know we already had one question from Jamie, which we will tackle right now, and I'll put my email again in the chat box. So that's all I got. Like I said, I try to keep it to 30 minutes to make sure that everyone kind of got their information. So what I'm gonna do is type up my email right now. Ooh, hold on. Type it in one more time. Sorry, guys. All right. So there's my email. I'm going to start going right into some of the questions here. The first one being from Jamie. Now, I don't know if you guys can see the question, but she asked me, hey, when I'm an investor, right, and I use my IRA to invest into any type of real estate syndication, is there something called UDFI or UBIT taxes on the capital gains? So what she's talking about is when my retirement account invests into any deal that is considered to be debt leveraged, right? Meaning my IRA takes a loan directly from a bank or indirectly, which is usually what you do in a syndication. Most multifamily individuals will raise 20 or 30% of the money they need, and the remaining 70 to 80% is borrowed from the bank. Well, the IRS says, hey, you're using a non-taxable taxable entity and indirectly taking a loan and making money that's not yours. So because of that, we're going to tax your IRA, that UDFI tax. This is okay because normally our IRAs, when they do an investment, are not subjected to tax. Therefore, my IRA cannot claim things like depreciation, tax deductions, insurance, HOA fees, anything like that. Normally, it cannot take those. But the minute you insert that UDFI tax, the IRA gets to claim all of those. And that's something that I think a lot of times people forget, right? That's something that a lot of times CPAs or tax attorneys, they're looking up UBIT, which is unrelated business income tax when your IRA is running a business, not UDFI, which allows the IRA to take deductions. So most of the time when we invest into any type of syndication, the first 1, 2, 3, maybe even 4 years, you get your K1s, and there's that negative value in the upper right. Well, we can take that negative value and save it all the way to the end when they either refinance or sell the property and subtract that from any of your gains. Typically, this will offset all of your taxation. If it doesn't, the amount of taxes you owe is very, very limited. It's less than you doing the deal yourself. But great question, Jamie. And once again, guys, you want to look up UDFI, not UBIT. So I love your question. I hope that helps. Feel free to elaborate if you do have anything else. Got another one here. Thanks for the presentation. It was very informative. I live in California. If I set up an LLC for my IRA, does it need to pay the annual tax of $800? Most likely, right? Because of the state you're in, a lot of states have different annual filing fees for an LLC. However, you probably can get away with setting up a trust, either a land trust, a personal property trust, or just a form of an investment trust. Understand that the IRA is its own entity, and when it sets up another entity, that entity is still going to always be labeled as a pass-through entity. Most states, such as Texas, where I'm located, in Texas, your trust does not need to file an annual fee like an LLC does. In addition, if you go with Quest is located here in Texas, so you can follow a lot of the Texas rulings if you use an attorney out here in the state of Texas that either set up the LLC or set up the trust. So great question there. Love it. I hope that helped. Bam. That's all the questions I see for now. If not, I can keep talking. I can keep going. But ultimately, guys, it doesn't matter which custodian you go with. You want to use a self-directed IRA for most of these deals for a couple reasons. Remember, I have probably more money in my retirement account than I do my own checking account. Most of these syndications aren't going to pay you today. You might get a quarterly payment or a monthly dividend payment or something like that, but it's not what you're living off of. You make all your money on the back end, the 3 years, the 5 years down the road. If I know that, why am I going to drain my personal checking account today for this deal when I can just use my retirement? That's already money. I'm already like, oh, that money's there. That's for the future. So let's use those IRAs. Let's use those old 401ks for these types of investments. So that's usually why we want to see people use their IRAs for these types of syndications. Multifamily, in addition, right now has been blowing up. If you would have asked me in 2017 what was our most popular investment, I would have told you it was something called notes. We had a lot of clients using their IRA, being a lender, lending their money to fix and flippers, to rehabbers, to seller financing on a rental home, something along those lines. But there has been a giant shift to syndications, things like multifamily. The reason why? The next generation, guys, they don't want to own a house, it seems like. They love the fact they can live in a nice apartment. Apartments when I was a kid were ugly. They were super ugly. They're not that way anymore. You can get an apartment with granite countertops. You don't have to deal with the yards and the maintenance issues, right? They have 2 beds, 2 baths, like the size of a house practically. And you don't have to maintain anything. I think the next generation really likes the apartment style living because of this reason. It's not that trashy looking places anymore. So I really do hope this was helpful, guys. I don't see any other questions on there. So I do want to just make sure that if you need to get a hold of me, feel free to reach out to me. I do my best to return my emails within, an hour or two. If I don't, I do have an intern that works for me. His name's Ronak. He might respond to you as well. So.
Sure, absolutely. Yeah. Thank you very much, Derek. So you'd like to add anything else for, audience?
I can't think of anything else. I know I tackled a lot of stuff on there, guys. It's a lot of information, but be careful what you research, right? Always feel free to reach out to me. I'm a free source to utilize. It doesn't cost any money to ask me questions, to email me, to give me a call. So
yeah, there is one more question.
Oh yeah. If I use a self-directed IRA to invest in hard money loans, such as a fund the flip, do I need to pay taxes? Absolutely not. That's one of my investments I do personally. I love to use my IRA to be labeled as the bank, be the lender, right? If I want to lend money to anybody, right, I can do so. They just need to secure my loan by things like a personal guarantee, maybe the property, like a deed of trust. I've even seen people secure loans with like a title to a car or like medical equipment. So being a lender is very easy. And because you're the lender, not the borrower, there is no form of UBIT or UDFI tax like we were talking about with Jamie's questions. So.
Awesome. Yeah. Thank you. Thank you very much, Derek. One more question, I think.
Sure. Let's see. Can we get the recording of this to review it? Yeah, I mean, I'm okay with it.
Yeah.
As long as.
Yep.
Yeah. And then if anyone wants my presentation that I just utilized, you can email me as well. I have no issues just emailing over my presentation. So.
Sure.
But, like I was saying, we see a lot of people using the retirement accounts right now to invest into multifamily deals.
Sure. Derek, can you also share me a copy of that so that if someone asks, I will also share.
Yeah, absolutely.
Sure. And thank you very much, Derek, for your time and presentation and answering questions. Excellent. Thank you very much. I really appreciate it. So I will, if someone asks, I will route it to you so that you can share, or it can help.
Sounds good. Sounds good. If there is anything else I can do for everyone out there, send me a call, give me an email, let me know what I can do for you. I'll put my phone number right here in the chat box real quick. But I hope to hear from all of you soon.
Sure. Yeah. Thank you. Thank you very much, Derek. And thank you everyone for your time. And feel free to reach out Derek, and also you can reach out me if you need anything like video recording or anything else. Absolutely. Thank you. Thank you, Derek.
Bye, guys.
Bye.